Welcome to Daily Trader here on the Schwab Network. I'm Alex Coffey sitting in for Kevin Hanks on this Thursday morning. It's January 16th, and we're about an hour into the market day. A much quieter day when you look at the overall market's movement today, but we did have some data and retail sales and initial jobless claims, both a little bit worse than expected, kind of clouding the picture just enough, but still pretty strong numbers. So on the heels of that massive rally yesterday post-CPI, the market seems to be looking for a base up at these levels. We're going to talk about a couple semiconductor names after we heard from one of the most important players in this space on their quarterly report in the overnight hours. That, of course, is Taiwan Semiconductor Manufacturing Company, TSMC, or the stock ticker TSM. They reported better than expected earnings, and they provided better than expected forward guidance when it came to revenue for the future. So stock being rewarded for that, jumping back near its highs, currently trading up over 5% on the session, a session that sees much of the rest of the market actually lower on the day. You can see this name. It's been a really, really strong winner over the last year. A little bit of a bout with volatility back in the summer of 24 when the overall market saw volatility. But for the most part, a pretty consistent and well-defined trend to the upside. We're going to talk example trades in both TSM as well as Nvidia, name oftentimes discussed alongside Taiwan Semiconductor. And so starting with TSM, what we're looking at here is a strategy that's basically looking for a move back to those all-time highs by the end of the month. And what we looked at in particular here was a call debit spread, but as structured, it's bought one strike in the money and selling a strike out of the money, but also at that potential resistance point near the all-time high. As this is structured, though, you'll notice the debit on this $7.50 wide spread, the 215, 222.5 in January 31st expiration, is $375. Well, that's exactly one half the width of a $7.50 wide spread. So it creates a risk reward that is equal. You risk $375 with a chance to make $375. With a break-even point, simply add that debit to the long strike at 215, you get 218.75. That's pretty close, within a dollar on a 215 plus dollar stock, talking 0.5% here of the current share price. So those are oftentimes the loose guidelines when you're looking at this sort of this one in, one out call debit spread, is to kind of structure it in a way that the risk reward is relatively close to equal and the break even is within a stone's throw of the current share price. Because if you think about it, a stock can go up, it can go down. And so kind of structuring it in a way that reflects that potential for those two outcomes. And so best case scenario, move back towards those highs, get above 225 by the end of the month and stay there. This can make $375, but it does take risk, and that risk is capped out, though, most importantly, below 215, limited to 375. On the heels of this jump in TSM, you do have an up move in Nvidia, building on some strength that it had yesterday as well, as the stock works its way back through the 130s and perhaps on to 140 or even 150. If you're bullish in this name, we don't hear from Nvidia in terms of its earnings released till late February, but say you wanted to set something up, you got this update from TSM, you got this, kind of resurgent of bullish activity yesterday in the overall market, and say you see a run towards 150 or beyond in Nvidia in the next month as we go into and lead into its own quarterly earnings, I have a strategy that would benefit from a move towards 150 by the February monthly cycle, which is February 21st. And so with this particular trade, what we're looking at is the call calendar spread. Now, most importantly, this is very customizable. I laid out the thesis for the 150 strike being the target, but if you have a different target in mind or a different time frame in mind, this could be adjusted. So when you're looking at this one in particular, this example trade, selling the end of the month, January 31st 150 call, and then buying the February 21st monthly 150 call, basically using that shorter dated option to reduce the overall cost of that longer dated option. That's the calendar spread in a nutshell. $1.75 debit means you have $175 in risk on this trade. But what you'll notice by that risk profile is it's really about precision. This is a strategy that does best if the stock does move towards that strike and get there pretty close to the expiration of that short option. However, you do have risk in both directions. This could overshoot to the upside, and it can, of course, not perform as well as you thought in this case, and actually underperform to the downside too. With this in mind, we oftentimes kind of describe this on Next Gen Investing on the Schwab Network every day, 1 Eastern. Jenny Horn and myself is sort of throwing a dart, and you aim small, miss small. So controlled risk, but a chance to return reward on that risk if it does move towards 150, and perhaps even do that by the end of this month. So 2 example trades, 2 really important semiconductor names in this AI build out, and both on the move to the upside today. Thanks as always for tuning in to the Daily Trader, and we'll see you tomorrow.